Welcome to your daily stock market summary from MarketSnap. Hey everyone, buckle up because today was a wild ride in the markets, and we've got a lot to unpack. From geopolitical tensions shaking things up to major moves in key stocks, there's plenty for us long-term investors to chew on. Let's dive into the action and see what it means for our wealth-building strategies. First up, the major indexes took a hit today as uncertainty gripped Wall Street. The Dow Jones tumbled over 1.5%, shedding hundreds of points, while the Nasdaq wasn't far behind with a drop of nearly 1.8%. The S&P 500 also slid by about 1.5%, and the Russell 2000, representing small caps, got hit hardest with a decline of over 2%. What's driving this? Well, a big chunk of it ties back to escalating tensions in the Middle East, particularly with Iran's threats to keep the Strait of Hormuz blocked, sending shockwaves through global markets. Add to that a spike in the VIX, the fear gauge, jumping over 12%, and you've got a recipe for a nervous day. Now, let's zoom out to the broader economic picture. The big story here is oil prices surging toward $100 a barrel amid the ongoing conflict. This isn't just a short-term blip, it's fueling inflation fears, with a key gauge hitting its highest reading in nearly 4 years. On top of that, hopes for Federal Reserve rate cuts are fading fast, with traders now expecting maybe just one cut in December. For us long-term folks, this means potential pressure on growth stocks in the near term, but it also signals a need to keep an eye on sectors that might benefit from higher energy costs. Plus, there's chatter about stagflation risks, where inflation rises but growth stalls. It's not time to panic, but definitely time to reassess portfolio resilience. On the brighter side, some large-cap stocks managed to shine through the gloom. Companies tied to commodities and energy were standout performers. Occidental Petroleum saw a nice bump of over 5%, riding the wave of soaring oil prices. Fertilizer stocks like CF Industries also surged, up over 13%, as supply disruptions from the Middle East boosted their outlook. Even consumer defensive names like Philip Morris climbed around 3%, showing that safe haven plays still have appeal in turbulent times. For long-term investors, these moves highlight the value of diversification. Having exposure to sectors that can weather geopolitical storms is key. But not everyone escaped the pressure. Tech and growth stocks took a beating today. Taiwan Semiconductor dropped over 5%, reflecting broader concerns about inflation impacting high-valuation sectors. Intel also fell nearly 6%, continuing to struggle amid competitive pressures. Even GE Aerospace saw a decline of over 5%, showing that industrial giants aren't immune to macro headwinds. In the short term, these dips might sting, but for us playing the long game, they could spell opportunity if fundamentals remain solid. Keep these on your watch list for potential entry points. Looking at the market movers, Nvidia remains a focal point despite a slight dip of about 1.5% today. It's still a heavyweight in trading volume, reflecting ongoing interest in AI and tech even amidst volatility. Apple and Amazon also saw declines of around 2% each, while Tesla dropped over 3% on broader EV sector concerns. On the flip side, Palantir bucked the trend with a small gain of over 1%, hinting at continued investor confidence in its data analytics play. These names are critical for long-term portfolios, so while short-term noise can shake things up, their strategic importance in innovation sectors keeps them relevant. Speaking of volume, the most actively traded stocks today tell a story of mixed sentiment. Nvidia led the pack as usual, showing how central it is to market dynamics. Intel saw heavy trading too, likely due to its sharp drop. Smaller names like American Airlines and SoFi also popped up with significant volume, reflecting retail investor activity amid the broader sell-off. High volume often signals emotional trading in the short term, but for us, it's a reminder to stay disciplined and focus on value over noise. Let's shift gears to earnings, as this week's calendar is packed with names worth watching. Big hitters like Adobe and Dollar General are set to report, and their results could give us clues on consumer spending and tech investment trends. Oracle already posted a strong Q3 beat, with shares jumping on cloud and AI demand, which is a positive signal for tech resilience. Costco also reported recently, and while specific numbers aren't the focus, their performance continues to underline strength in consumer staples. For long-term investors, these reports are less about day-to-day swings and more about confirming secular trends. Are these companies building sustainable growth? You can find exclusive earnings transcript summaries on MarketSnap. Over the past week, some large-cap gainers have caught attention despite today's downturn. Garmin led with a massive 21% jump, showing strength in consumer tech. AppLovin and Shopify also posted double-digit gains, around 14% each, hinting at pockets of optimism in software and e-commerce. Occidental Petroleum, again, was up over 14% for the week, benefiting from the energy spike. These weekly moves remind us that even in choppy markets, specific sectors or stories can drive outsized returns, something to consider for strategic allocations. On the flip side, the past week saw some notable large-cap losers. Genuine Parts Company dropped over 20%, reflecting challenges in the auto parts space. Rivian slid 14%, continuing to face EV sector headwinds, and Blue Owl Capital fell nearly 14% amid private equity concerns tied to liquidity issues. These weekly declines highlight short-term risks, but for long-term investors, they could signal potential bargains if the underlying businesses remain sound. Sector-wise, over the past week, industrials topped the charts with a gain of nearly 2%, showing resilience amid economic uncertainty. Consumer cyclicals also performed well, up over 1%, suggesting some consumer confidence persists. Energy, not surprisingly, surged over 4% week over week with oil's rally. These sector trends are worth noting for long-term portfolio balancing. Energy's strength could be a hedge against inflation risks. On the downside, healthcare lagged over the week with a drop of about 0.6%, possibly due to profit-taking after prior strength. Utilities and financial services also saw slight declines, reflecting sensitivity to interest rate expectations. While these sectors aren't the headline story today, they remind us to keep a diversified approach as different parts of the market react uniquely to macro pressures. Wrapping up the bigger picture, the S&P 500's pullback today aligns with a broader reversion to the mean narrative after years of strong returns. Analysts are noting that 2026 was already expected to be a tougher year, and geopolitical shocks are amplifying that. For us long-term investors, this isn't a signal to jump ship, but to stay strategic. Focus on quality companies with strong balance sheets that can navigate these bumps. Similarly, the Nasdaq's tech-heavy composition makes it vulnerable to rate hike fears and inflation pressures, as we saw today. But remember, tech's long-term growth drivers, think AI and cloud computing, haven't disappeared. Short-term volatility can be a chance to build positions in innovators at better valuations. That's a wrap for today's stock market summary from MarketSnap. Thanks for tuning in, and make sure to stick with us for daily updates, deep dive SWOT analyses, and all the insights you need to build lasting wealth. Hit that like button, subscribe, and we'll see you tomorrow for more market action. Stay sharp, investors.